One of my goals for this year is building a long-term buy and hold stock portfolio. So in this video, I'm going to show you what stocks and funds I'll be picking to build out my portfolio and how you can do so for yourself. So most of my activity in the stock market is fairly active trading on a daily or weekly basis. Other than a couple of retirement accounts with long-term positions, my only real buy and hold stock portfolio is in M1 Finance. I started this in January of 2020 with just $1,000, holding just one Vanguard ETF. But for a long time, I've been wanting to add new holdings and start to make regular deposits to this account. One of the downsides of day or swing trading is it requires you to actively be participating and managing. And sometimes I just don't want to. It can take up a lot of my time, and out here in California, sometimes I just don't want to wake up at 6 in the morning to deal with it. And with trading, you can easily have a few bad weeks or months, and in those cases, you'd be a lot better off if the money just sat in a solid portfolio, earning you money while you focus on other things. So with most things in general, I like to keep things pretty simple. And to simplify this, your buy and hold portfolio can consist of individual shares of companies like Apple, for instance, or it can consist of a bunch of different companies all put together into one fund. And it can also consist of bonds, but I'm going to leave bonds out of this video and just focus more on stocks. So let's take the S&P 500 for instance. The S&P 500 is an index of 500 public, large cap stocks that represent the leading industries of the US economy. Within the S&P, you have 11 sectors based on the company's primary business activities. They are information technology, healthcare, financials, consumer discretionary, communication, industrials, consumer staples, energy, utilities, real estate, and materials. So companies like Microsoft and Apple would be in the information technology sector. Tesla, Home Depot, Starbucks, and Amazon would be in the consumer discretionary sector. If you wanted to create a portfolio consisting of all 500 companies in the S&P, you can go out and buy shares for all 500 companies, but that would be a huge hassle and may cost a lot in commissions and just otherwise be difficult to manage. Instead of doing that, you could just buy one share of an S&P 500 ETF like SPY. This ETF consists of all the companies that make up the S&P 500, and so buying just one share of this ETF will give you exposure to all 11 sectors and all 500 companies. Now, the downside to this is since it's so diversified, it also won't get crazy high returns. The average annual return is about 10% for the S&P. I already mentioned the 11 different sectors, but stocks can also be classified based on their expectations. Stocks can be growth, income, or value. Growth stocks are stocks that, well, they have a lot of potential for growth. They are generally expected to invest most of their revenue into growing the company. All 11 sectors will have their own growth stocks, but in general, growth stocks are newer, innovative companies that are expected to have a big impact on the market. Tesla and Amazon are good examples of growth stocks. Value stocks tend to be established companies that are currently trading below the price that their fundamentals might indicate. Essentially, they are a good value for the price you pay. It's one of the reasons why Roaring Kitty bought up GameStop over a year ago. He found some deep freaking value and was rewarded for it. Often you'll find banks and energy companies as good examples of value stocks. And lastly, you have income stocks. Income stocks are stocks that pay a dividend to their shareholders, and they are usually companies that are well established and have healthy financials. An example of this would be a company like 3M. They have a dividend yield of almost 3%. This means each year 3M will pay you about 3% of their share price per share that you own. It's currently around $200, so you get about $6 per year per share. So you've got companies with different pros and cons in a variety of sectors, and maybe all this did was further complicate things for you, but don't worry, it doesn't have to be this difficult. This brings us back to ETFs. There are a lot of companies that make ETFs, but let's take a look at Vanguard's ETFs. I like Vanguard's ETFs because the expenses are low and the returns are pretty solid. To see the fee for any given ETF, it'll be listed as an expense ratio. With Vanguard, I find the fees are usually pretty negligible considering the returns, but it is something to be aware of and know about before investing in any ETF. But back to diversifying, ETFs make this easy. If you want dividend stocks, well, here's VYM. You can look at how it's performing year to date and how it's performed since the fund was formed. If you want to be exposed to growth stocks, here's VUG. For value stocks, here's VONV. And then you can just click on one to see what companies that ETF is holding. This growth ETF is comprised of 46% tech stocks and 23.5% consumer discretionary. You've got stocks like Apple, Microsoft, Amazon, Tesla, MasterCard, and so on. So if that fits your investment goals, you can grab some shares of this ETF and you're all set. So how much diversification should you actually have in your portfolio? First, let's see what Warren Buffett has to say on the matter.
The question is about diversification. If you really know businesses, you probably shouldn't own more than 6 of them. I mean, if you can identify 6 wonderful businesses, that is all the diversification you need, and you're going to make a lot of money, and I will guarantee you that going into a seventh one is going to, rather than putting more money in your first one, it's got to be a terrible mistake.
6 stocks? That's pretty surprising, but honestly, it's up to you and your goals and your risk tolerance. For instance, here's one of my friend's buy and hold portfolios. It consists of quite a lot of stocks, and he's covered different sectors and even crypto. Oh, and I forgot to mention that Boomer is the 12th sector of the S&P. So if you're older and closer to retirement, you may want to conserve your cash and focus more on income stocks that pay dividends. If you're younger and you want to focus more on higher returns with higher risk, you can choose growth stocks that have potential to beat the overall market with their returns. For me, I'm still relatively young, and thus I'm okay with having a portfolio that's focused more on growth to get potentially higher returns. I don't want to focus so much on perfect diversification. So let's take a look at my portfolio and what I'll be doing with it. So I mentioned M1 Finance earlier, and the reason why I like using M1 for my buy and hold portfolio is because that's really what it's designed for. Unlike brokerages where you can day trade and buy options, M1 has you build a pie of different stocks and funds, and then you set what percentage of your investment you want allocated to each one. Instead of buying and selling whenever you want, they have trade windows. So the market's closed right now, but I can get my pie set up and then M1 will make the transactions for me at the next time there's a trade window, which is tomorrow morning. Now, if you don't want to use M1, that's totally fine. All you'll want to do is figure out how much you want to allot to each stock or fund and just buy that amount directly through your broker. My first year with this portfolio, I had just one ETF, Vanguard's ETF VUG, and this actually gave me pretty terrific returns for an ETF. Then earlier this year, I added ARK's Innovation ETF, ARK-K, Apple, and Disney. So now here's how I'm going to build out my portfolio. I'm going to hold on to the Vanguard and ARK ETFs along with Apple. I'm going to also add ARK-G, which is focused on genomics with companies like Teladoc, Regeneron, and CRISPR. I'll add VONV for exposure to value stocks, which cover a variety of sectors like financials, industrials, and consumer discretionary. I'll add Amazon here as well. There's speculation of a stock split and earnings also on Thursday. So to balance my portfolio, it is growth focused, so I'm going to make VUG 40%, ARK-K 15%, ARK-G 5%, VONV 20%, Apple 10%. Oh, and I'm going to get rid of Disney since it's covered pretty well in the value stock ETF, and then Amazon will be 10%. I actually just realized I hit Warren Buffett's magic 6 number, which really wasn't intentional, but I feel pretty good about how it's currently set up. Another thing I would encourage, if you're able, is to make it a habit to contribute regularly to your portfolio. I made a free budgeting spreadsheet that you can download without even entering your email, linked below, that can hopefully help you figure out what you may be able to invest each month and then how much your investment can grow over time. For me, I'm just going to start by setting up a $300 monthly transfer to this portfolio. I'll also do a follow-up video to this at the end of the year to track how well this portfolio is done and share the results with you. Now, I could add more speculative plays in EV and cannabis or add more blue chip boomer stocks like Coke, but knowing how I am, I don't want to get stuck analyzing so many options that I get overwhelmed with information and then end up not doing anything at all. I may adjust things over the next several months until I feel like I hit a good balance of growth without too much volatility, but this at least gets me going. And now this video isn't sponsored by them or anything, but if you do want to check out M1 Finance for yourself, you can use my link in the description and you'll get $30 for free when you deposit $100, but feel free to use whatever brokerage you like the best. I'll also put a link to this pie that I created in the description so you can check it out for yourself. As always, I recommend doing your own research before investing your own money and not blindly taking advice from dumb YouTubers like myself. That's all for this one. If you would do me a favor, hit the thumbs up button on this video, consider subscribing to this channel. That would really help me out, and I will see you in the next one. Bye.